If you're out here selling naked puts, you need to know how to manage your risk. Otherwise, you're going to enter a max loss scenario, something nobody wants to do. So here's how you can manage risk with a stop loss while setting up your trade on the Interactive Brokers TWS platform. First things first, in TWS, you want to pick a stock from your watch list. Here I've got a whole bunch listed that is going to be going up. At the very least, it's going to be neutral. When you're selling naked puts, you want to have an upwards or neutral market. Otherwise, you're going to get assigned lots of shares, and it's going to chew up your capital requirements very quickly. So I'm going to use the Coinbase for this demo, COIN coin, just because I think it's on a bit of a holding pattern right now. As you can see in the chart here, it hasn't really moved too much from this kind of lower level and slowly kind of ticking higher in the last couple of weeks. Once you have your stock selected, you're going to go into the options chain here and you're going to pick your expiration date. If I pop this open, you can go 5 days, 12 days, 19, whatever it may be. I'm going to go on June 21st, which is the third Friday in June, only because for this demonstration, there's way more volume and the bid-ask spread would be a little bit tighter by comparison to the other days in here. So I'm going to go in here and then you're going to pick your strike price. And when you go to sell this put, remember, you want to go into the put side here on the right-hand side. You want to go down, make sure that you're in the red column, not the blue. If you go into blue, it's going to be buying for you. You want to be selling this naked put, right? So let's go down. Let's go 220. Okay, 220's got good option interest, got some volume. Let's go and let's click on sell right here. We're going to get paid between 9:45 and 10:20. For this example, I'm going to go ahead and here to your order entry area now. I'm going to close this down. And in your order entry area, we're going to click on sell, because we want to sell that put, right? We want to sell that and get paid that capital to open up this position. Quantity of one contract is 100 shares. Limit order, which means it's going to get filled at this limit price. Otherwise, it won't execute. You can do market order if you wanted to. It's going to take the available price that the market is trading at for this option contract. I prefer to go limit. In my experience, has been the best for me, but do so with what you want. Limit order, 9:45. Again, I said 10, so I'm just going to click in here, right here, and scroll up. We're going to go 10 to make this super simple for the math part in a second. You want this order to be in for a day if you're selling this option for one kind of trading day. If you want it to be good till cancel, you could do GTC, but normally most people are getting the day area and just kind of get it in the market, get in the hopper. And then you have the luxury of setting up your stop loss for this put option. Okay, you're going to sell this contract. And by clicking this button right here, this advanced button right here, click there, that plus button. Then you go over and you click on attach stop loss / profit taker / bracket. This plus button right here in the top three. Now you have the ability to go in and set up a stop loss that's going to actually be attached to your naked put that you sell. So if I did this, I click on the stop loss button right there. You can see in the top order entry plus stop loss has changed. If I click this off, it goes away. So you want to make sure that that's highlighted there as well in TWS, the stop loss at the top. We're not going to worry about a profit taker right now. That's on the upside when we're going to close out the trade for a win. We're trying to protect our downside loss and protect this trade from going too far against us. So in this scenario, we have a stop order, which means if the price of this option contract goes from $10, which we're going to sell it for, and the value of it goes up to 11 right now, we're going to change this in a second. But if it was to go up to 11, then this stop order would be triggered and we would lose a difference of $10 minus $11. So we'd lose $100 in this trade. We would give back essentially that $10, which is actually $1,000 in premium, and we'd have to pay an extra $100 on top of that because it's $11 per share, 100 shares. So 11 times 100 is what, $1,100 versus 10 times 100, which is $1,000. Okay, that's how that math works. Right there. I'll pull up a calculator real quick. We'll go through it just to see it in live time. So you sell the contract for 10 times 100, and you get paid $1,000. When the contract's worth 11 times 100. Contract worth $1,100. So you got paid 1,000, but the contract's now worth 1,100. So you have to go 1,000 minus 1,100, and you're down $100 on your overall trade. So to do this, we want to be able to set this area at an area where we have like maybe 20%, 30% risk in the trade, meaning that if we got paid $1,000, we will be okay taking on the risk of maybe 30%, which is $300. So this would then change from 11 to 1,300 or 13. We just go in here and type 1300. And that means we would lose $300 if this trade was closed out at our stop loss of 13, which means, again, the value of Coinbase's stock would be going down, which would be driving the price of this option contract, this put option, up. When you're selling a put option, you want the price to go down. When it goes down from 10 to 9 to 8 to 7 to 6 to 5, that's profit that you're locking in as an unrealized gain. But when you actually close out your trade, that's profit that you're realizing in your account. If it's going the other way, right, and the price of Coinbase is going down, it's going to start inflating from 10 to 11 to 12 to 13. It's going to cost you more to close off the trade. It's going to cost you that $13 per share to close it off when you only got paid $10 in the beginning. So again, our math is very simple in this example. We're getting paid 1,000, but the contract is worth 1,300, right? Which is just 13 times 100. So 13, right? We take that and we subtract it from 1,000, which you got paid from. You have to give back 1,300, so you're down $300 on the position, which means you're stopping out, you're managing your risk appropriately according to your account size or whatever you're going to do. But you could do 20%, which would be 12, right? That'd be 20%. You could do 10%, which would be 11. You could do 50% if you wanted to go risk reward and have the risk reward ratio be at 2. 2-to-1 ratio is generally an accepted practice in terms of what you're trying to do for some trading strategies, where you're trying to get two times on the upside versus 1 on the downside. So you may be at 15, and you're saying you get paid $10 per share, which is great. And I'm willing to give back $500 as my total stop loss for the position if it doesn't go the way that I want it to. The beauty with selling put orders, though, is that if the stock price stays the same, you're getting theta decay and the price is slowly changing. If the price goes up, obviously you win. And if the price goes down, then yes, you do have to have an idea of where the stop loss may be, or you just take assignment of the shares. That's the other thing. You don't have to use a stop loss. You could also take assignment of the shares in this scenario. But let's say we wanted to do, again, our 30% potential loss on the trade. We'd go 13 because, again, it's 30% higher than $10. And we would then have this day checked on, and we'll check it good till canceled, because you want to have this stop loss on indefinitely till the position closes, which means if it's only on day, once that trading day is over, the stop loss is gone. You have to set up another one. We don't want to do that. We want to have it on indefinitely while the trade's live until we close it off. So we're going to go in here and click good till canceled. And then we just go ahead and click submit right here, this button right here. That's going to put us into our order preview area. And we're going to get paid again. Stop price of 13, right? We have a bid ask of $9.45 to $10.20. We're going to get paid, again, our $1,000 roughly. And we're going to override and transmit this. And now we see it in the bottom there. I pop this open. We've got a Coinbase. Let's open this up. Put. We have sold. We have a limit. We have a limit price. We have a quantity of 1. We have a stop price of 13 attached to this limit order, where we're going to buy to close, because we're going to sell to open. When we sell our put, we're going to buy to close the stop loss, right? That closes off the trade at our $300 loss scenario. Once this price is accepted, it goes into your portfolio. This stop loss trade gets tacked on right along with it, and you're good to go. The big thing is that understanding that when you put this in, they're tied together. So if you were to go and close off this trade in the portfolio after a couple of days for profit, this trade would be just a buy order when you're going to close it off, and this stop loss would just get closed off automatically. It wouldn't be in play anymore because you'd be closing off the trade for a profit. It's only going to execute when you hit that $13 price movement on the contract. And you can look at that and say, hey, when is this likely to happen? Well, if you look at the delta, here's a quick way to calculate when and if that could happen. The delta on the stock is 30 right now, which means that for every dollar that the price of Coinbase goes down, this option contract value is going to change by about 30 cents. Okay. Which means if it's going to go, and let's just assume in this example, delta is going to stay the same. It kind of changes as the price goes up and down, but let's keep it at 30 right now. So 13 is our kind of price point, right? And we subtract that by 10, it's 3. So we have a $3 move on the contract that's available to us. And that means that if we divide 3 by 0.3, the stock price of Coinbase would have to go down by $10 for this stop loss to get hit in this example, assuming that delta stays the exact same. Okay. If delta increases as the price goes down, which it kind of does, it's going to be a little bit less than 10, but that's just a general ballpark for this example. So that's right now, the Coinbase stock is trading at 237. So if it got down to 227, roughly, that would be where the order would get executed and you get stopped out. You can see here as well on the chart for the actual put itself, if I open that up, but you can see here we've got a sell order at the $10 limit again, and we want the value of this contract to keep going down, 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 down. That'll happen as the price of Coinbase goes up, up, up. They're kind of inverse on the chart. We have our buy stop order at $13 on the chart there, graphically entered, meaning we put this in the right way. And that is managing risk with stop losses, attaching them to your naked puts inside Interactive Brokers. My name is Andrew Ferguson, and I teach new investors how stock options work using the Interactive Brokers trading platform. If you want to learn more, I invite you to subscribe to the channel. Thank you so much for watching this video, and I will catch you on the next one.